Long before the markets blink, something measurable shifts in the way people behave, and it shows up in the most unexpected place imaginable. 18 months before some of the biggest financial collapses in history, three completely unrelated things start acting weird at the same time, and nobody can fully explain why. Stick around, because by the end you'll never look at a calm market the same way again. Fact 1. The lead time. Researchers studying past crashes keep stumbling on the same eerie window. Roughly 18 months before a major collapse, certain social and natural indicators start drifting off their normal baseline. It's not a single signal, but a cluster, which is what makes it so hard to ignore. The pattern doesn't predict every dip, but it tends to show up before the big ones. Fact 2. Divorce spikes. Some economists have noticed that divorce filings can quietly tick up before financial turmoil hits the headlines. The leading theory is stress. Households feel financial pressure long before official data confirms a downturn. People often sense instability in their own lives months before any analyst calls it a recession. Fact 3. Birds off schedule. Strangely, bird migration timing has been logged as shifting in some years that preceded market shocks. While migration is driven by climate and food, citizen science databases show unusual deviations clustering around turbulent periods. Skeptics call it coincidence, but the timing keeps catching researchers' attention. Fact 4. Solar flares. There's a long-running, controversial idea that solar activity correlates with human mood and risk-taking. Some studies link peaks in geomagnetic storms to shifts in trader behavior and market volatility. It sounds wild, yet papers in finance journals have seriously examined the connection. Fact 5. Mood theory. The common thread connecting these oddities might be collective human emotion. A field called socioeconomics argues that social mood drives markets, not the other way around. If mood shifts first, you'd expect to see it ripple through relationships, behavior, and spending well before prices react. Fact 6. The Hemline Index. Decades ago, observers claimed skirt lengths rose in booms and dropped in busts, dubbing it the Hemline Index. It's mostly a fun footnote now, but captures the same core idea. Culture seems to flicker before finance does. These quirky indicators survive because they occasionally line up uncomfortably well. Fact 7. Correlation trap. Here's the honest catch. With enough data, you can find spooky correlations between almost anything. Cherry-picking a few matching events doesn't prove one causes the other. Real forecasters demand mechanisms, not just patterns that happen to rhyme. Fact 8. Why economists miss it. Traditional models lean heavily on numbers like GDP, interest rates, and unemployment, which often lag reality. By the time those figures flash red, the crash is frequently already underway. That blind spot is exactly why offbeat early signals keep tempting researchers. Fact 9. The sentiment edge. Modern analysts now scrape social media, search trends, and consumer surveys to catch mood shifts faster. These soft signals sometimes move before hard economic data does. It's a quiet admission that feelings, not just fundamentals, can foreshadow financial storms. Fact 10. What it really means. No single weird metric can reliably call a crash, and anyone claiming certainty is selling something. But the recurring 18-month cluster is a reminder that markets are made of people, and people broadcast stress in surprising ways. The smartest move isn't prediction. It's staying alert when too many strange signals align at once. So is it coincidence, hidden psychology, or something we haven't figured out yet? Drop your theory in the comments and subscribe for a new mind-bending fact every single day.